While everyone's been obsessing about crypto and tech stocks, the real wealth transfer has been happening in gold and silver in the precious metal markets. So if you're not positioned properly for this, you could be missing out. We're here to help you take advantage of this. With gold smashing through $3,400 an ounce recently, this is probably more than just your everyday boilerplate rally. It could even be a signal of something going on under the surface. There's a lot of things to be concerned about, a lot of news items that's been happening. We're here to help you decipher some of that and to help you take action for yourself. So welcome back to the channel. If you've been watching the markets lately, you know that we've been living through some pretty historic times for precious metals. Precious metals have been in a long-term uptrend for many years now. Gold has been making new highs, and probably for good reason. Gold just touched $3,400 an ounce. Today, we're going to dive deep into what that means for you, why it's happening, what's driving them, and what you should do about it right now. Gold has just surged to unprecedented levels here in 2025. U.S.-China trade tensions. At the same time, Trump has been threatening Fed Chair Jay Powell, threatening the Fed's independence, basically saying that Trump wants to fire Jay Powell. The market's starting to sense instability. The market's starting to sense that the Fed may not be as independent as most of us thought. If that's true, it really says that this financial system may not be stable. And whenever there's instability, gold takes off. Well, the rally in gold is further supported by central bank gold buying. Central banks have been buying for many years. That central bank gold buying has only been accelerating in recent years, thereby pushing the price of gold higher. Investors are really concerned that their purchasing power is at risk. Maybe they're concerned that the money system isn't real and that the fiat money system may be coming to an end, at least an end as we know it. So we're concerned about all of those things too, but the market is really picking up on that lately. Here in New Harbor, we've embraced precious metals pretty much since we were founded in 2005. We're lucky enough to be in our 20th year. We've been trying to educate investors about this ever since the beginning. All of those years have not been easy. Gold actually peaked out in 2011 and then went in a 40% bear market in the years that followed. We finally bottomed from the high in 1800 down to around 1000 or 1100. But since there, it's been basically building a base all of those years. So here's a monthly chart of gold. As I mentioned before, we started our business back here in 2005, and there was a nice uptrend. But then this bear market, I'll be honest, we weren't really anticipating just how deep this bear market was. This bear market was about minus 40%, and it bottomed sometime in 2016. But even after that, we went sideways for a bunch of years. We built the right side of this base. And then this was pretty frustrating. 3.5 years of sideways move around $2,000 an ounce. And you can see now just how vertical the move in gold has gotten. And I'll be the first to say that you need to be cautious here with this kind of vertical parabolic move. But this chart of gold and gold itself has outperformed many other assets. And there's no real telling where this will end. I can only say that it's been really, really strong. So gold has served as a store of value through all of this time and through all of these troubles. And it's probably no surprise that a lot of our viewers know that we subscribe to the fourth turning theory. We're at a climactic phase in markets. The next few years are probably not going to be easy. I believe that this is a climax. And I think the fourth turning, as Neil Howe has stated himself, probably did start back in 2008. And that means we're close to 17 years into this fourth turning. So the next few years should be pretty climactic, and a lot of surprises are likely to come. So the market's worried about this. And clearly, gold is signaling something, some type of danger, some type of instability. So what's driving this incredible rally? Gold's diverse demand drivers mean that it's risen in both periods of falling and rising U.S. bond yields. And it's well positioned to act as a hedge for uncertainty in 2025. The U.S. dollar decline has also helped. Recently, the U.S. dollar has fallen from about 107 or 108, actually touched 110 recently, and now it's just down around 100 or just below. So it's about a 10% drop in the U.S. dollar. Gold was actually rising before that, even with the dollar rising. So with the dollar going down, it's only given gold more of a tailwind. This is the chart of the gold to silver ratio going back to 1995. As you can see here, if you divide the price of gold by the price of silver, it tells you how many ounces of silver equals 1 ounce of gold. The ratios trended somewhere between about 40 and maybe 80. The long-term average is probably around 60 or so over this time frame. The gold to silver ratio has just recently shot up above 100 to 1. The last time that's happened was back in COVID, and we touched about 120. But let me just zoom in a little bit on this chart. During COVID time, we hit about 120 just for a short period of time. It proved to be a really good buying opportunity for silver. And now we've trended around 80 to 1 in recent years, but recently we shot up to about 104, 105 as of today. This has historically been a very good buying opportunity. This is not a good timing signal. It doesn't mean that silver is guaranteed to go up. It just means that silver could very well have some kind of snapback, particularly if gold doesn't collapse from here, which I don't think it will. So consider the fact that silver is likely a better buy than gold right now. And consider that when looking at your own mix, if you have a mixture of gold and silver. Happy to talk with you about some recommendations if you want to talk specifically. We can't give advice without knowing your specific situation, but in general, silver seems to be a better buy now than gold. Our intermediate term target for silver is $38 to $40 an ounce, and then ultimately surpassing the all-time high of 50. So gold is already at new highs at $3,400 an ounce. Silver's been lagging. The reason it's been lagging, we don't know. There's a lot of different reasons. And you can see the fact that it's been lagging in that chart that I just showed you about the gold to silver ratio. However, it's very likely that silver presents a better opportunity. Let's talk about the mining shares. Gold mining stocks provide a leveraged exposure to the price of gold and silver. The really big driver for the mining sector could be and will be explosive margin expansions if we see a continued sustained price in gold and silver. High and stable commodity prices, inflationary policies worldwide, and simultaneously low energy prices create a perfect storm for mining shares. As the price of gold and silver go up, if they continue to go up, more and more of that profit flows right to the bottom line. So that's called leverage. So gold miners are historically undervalued relative to gold, and that's likely to reverse. It's already started to reverse some in recent weeks. Some of the major ETFs like GDX and GDXJ have hit what we consider to be our intermediate term, short to intermediate term targets. We have adjusted our own hedges. We've actually rebalanced our positions along the way at lower levels. As those positions have grown, we've just tightened up our hedges by selling covered call options on our 10% position in miners. And if we keep increasing from here, we'll either rebalance to our target of 10% and or even reduce the position a little bit. But we've learned not to call an ultimate top. When things get very bubbly and get explosive, there's no telling where they can go. So we just want to keep our eye on it and be balanced and remember not to get too committed. Always keep your position size in check so that you can sleep at night, so you don't hyper focus on things and get too emotional, because emotions are the enemy to the investor. Investors have been looking really only at Mag 7, tech stocks, the S&P, crypto, and really haven't focused yet on the mining space. It's a really small space, and it's so small that only one stock in the mining space is in the S&P 500, and that's Newmont Mines. In fact, they're reporting earnings this week. We will see what they bring. That creates opportunity for investors. Let's take a look at the ratio of gold miners to gold itself. This goes back to 2007. It's about 18 years. You can see that we've been pretty stretched to the downside. Now, I'll be the first to admit that we've been stretched to the downside for a long time. And we were in miners a lot of these years. And so this is not a slam dunk saying that we can see the future. We were early here. All I'm really saying is that there's a great opportunity here, and it's still here. If you don't already own them, be careful. Don't go all in. Talk to us if you'd like to. And remember, we're only at 10%, I said earlier, and we're hedged. So nothing in this life is a sure bet, but it certainly looks like a very good opportunity here at these levels. So let's talk about strategic considerations when it comes to gold and silver and the miners. Gold price moving higher tells us something about what's important to investors, and it tells us something about economic confidence. Gold does really well when investors and savers are concerned about maintaining their purchasing power in fiat instruments, or fiat currencies are what countries produce, called money or currency. Almost all currencies are fiat currencies now, and they're only backed by the government, the printing press, I guess in theory, the GDP or the gross domestic product output of that country. But really it comes down to faith, right? And so when investors lose faith in that fiat currency, gold prices move higher, silver prices move higher in general. So that brings us to the million-dollar question. Where are we in the cycle? That's what we want to talk about. The data suggests that we're early or in the middle of the cycle at best. So we're in early innings. If you want to use a baseball game analogy, I don't think we're at the top. I think that we may not see the top for years, even in gold and silver. I would say that the vertical movement that we showed you earlier may mean that there's a pausing or even some kind of pullback here. So again, you've got to be careful, but I think there's plenty of time to be thinking about this and to be establishing a position. Since we're early in the game, what does this mean for you? What are our targets? Well, gold is sitting here at $3,400 an ounce, and we've been on record and in videos saying that we think near term we're looking at 3,200 to 3,400. So we're right there right now. So what's the strategy with miners and gold and silver all reaching their targets? What should you do? Well, with gold bullion, with silver, here's what I would do. As we said before, as we've been saying all along, 5 to 10% of your investable assets should be in precious metals, a mixture of gold and silver. We can talk about that in a little bit about exactly how we do it. It doesn't matter exactly the mix, but get into precious metals 5 to 10% of your investable assets. I'd probably dollar cost average into it at this point. I'd either buy a third now, a third in a month or two, and a third later. Or if you're a little more impatient and want to get into it quicker, buy half now and half in a month or two. In the mining space and in the bullion space, actually, if you're doing paper, gold, and silver, you can hedge. You can sell covered calls against these securities, particularly the mining shares. So we're getting up to levels where we might go sideways for a while. So if you're buying mining shares, you could buy the stocks and then sell covered calls against them. You can't do that with bullion, but if you happen to be buying GLD or SLV, which by the way aren't really our favorite ETFs, but they are good for selling calls, you could sell covered calls against them. Feel free to reach out to us if you'd like some advice on that in particular. Yeah, you may ask, is it too late to get into this? Yeah, in short, absolutely not. Your entry strategy does matter, as we just pointed out, and the targets that I laid out are still higher than current prices, but we don't want you to get shaken out or to feel any turmoil or any heat, so to speak, if we get a sharp and sudden pullback. So think about these things. How much do you already own? If you don't own any, you should just get started. Get started with a little bit. If you own too much, or if you feel like you own too much, now's the time to actually sell. And you have to psychologically be okay with selling into an up market, because most of the people we talk to are just selling a little bit. You might sell 10% here if you're over allocated. You should want that market to keep going higher because you still own 90%. You want to make money on what you've got left. And, frankly, I think that we're in a systemic move here higher, a realization phase that central bank money printing is not going to be the end all be all forever. So it's probably going to be an uptrend for many years. In terms of your mix, I showed the silver to gold ratio. That really favors silver over gold. For the longest time, we recommended something like 3/4 gold, 1/4 silver, or 2/3 gold, 1/3 silver. Frankly, because of the extremity of that ratio, I would go, if you can, and if you got the storage space, I'd go maybe half silver, or maybe even a little more than half silver based on these recent ratios. Again, for your particular situation, give us a call if you want to talk it through. Don't go all in right now. Even in the strongest bull markets, diversification remains important. You have to be able to handle this trip, this path mentally. Gold and precious metals should be a portion of your portfolio, not all of it. Gold miners have a very low correlation to the stock market. They are correlated, and they have in the past gone down when the stock market went down, but they're not as correlated as most people think. We actually categorize mining shares as something different. We have them categorized in a gold and monetary metal sleeve, and because the correlation is often opposite. You might see gold and silver miners go up when the market goes down. So it's not a given that they're going to follow the market. So let's wrap this up. We're experiencing historic moves in precious metals. Both gold and silver are at all-time highs. The fundamentals remain super strong. Central banks are buying. Geopolitical tensions are increasing. The president is threatening central bank independence. And there's currency debasement all around the globe. Fiat currencies are starting to flail. Bottom line. Remember, successful investing isn't about timing the absolute top or bottom. It really isn't, even though mentally and psychologically, that's what we are tempted to try to do. But really, all you have to do is position yourself for the meat of the move. Just get exposure for the meat of the move. And the trend in precious metals and miners remains up. And I think it's going to remain up for a while. So if you enjoyed this analysis, please hit the like button. Subscribe for more updates to New Harbor's videos. And let us know in the comments down below what precious metal questions that you've got. We do read them. We're happy to respond. We thank you for tuning in, and we wish you the best of success in investing and in your whole life. Thank you.